So once again, we find ourselves on a Monday with the world in flux. This is becoming kind of a crazy pattern that we're seeing the last 2 years. Obviously, the latest is Russia's invasion of Ukraine. Um, this is a real estate show, so we're going to keep it focused on the impact there. Mondays with Mike, by the way. If you've been watching this show for a while, you know that the things that we really tend to focus on that drive the real estate market are interest rates. That's a big one. Inflation, the economy generally, and employment. So we can start there. I mean, we already were in a situation where we had high inflation. I think most people expect what's going on with Russia uh, to just make that worse. We're probably looking at some kind of energy crisis, and we're seeing in the other markets, the stock market, the bond markets, the currency markets today, they've all been kind of roiled by not just the possibility of commodity and raw materials prices going up, but also the cutting out of Russia from the financial system, way beyond the scope of what we can talk about here. I don't even think I fully understand what's going on with that yet. But one thing is for sure, we're looking at shorter term spike in inflation than what we've even seen up to this point. So that's going to make it more expensive to build homes. It's going to make real estate in general more expensive. Now, what about the Fed? Are they still going to raise rates in March? Because they've been talking about doing that. And when rates go up, it makes it more expensive to borrow. It makes housing less affordable. So that's supposed to be a counterweight to inflation and rising prices. Well, from what I'm reading, it looks like the Fed is going to keep that on track. There were a few people I read this morning who were thinking along the same lines that I was, that this is reminiscent almost of like the early to mid 70s, where we had the Iranian Revolution and there was an oil shock during that period. We had stagflation during that period where rates had to be moved up to fight crazy inflation. Paul Volcker, the Fed chairman, famously broke the back of inflation. By 1980, which was before I was born, but many who are watching this may remember, the rates were at like 20% at one point. And I'm not exaggerating that. So there is a lot of room to go where we are now to where we could go with rates is a big gap that I can't even. It not only will it not fit in the camera, my arms won't stretch that far. There's a lot of room for the Fed to operate, and if inflation is going to continue to tick up, I think it's very likely that they keep those rate increases intact. Now, we've talked about this actually a month or so ago. I talked about the risk-free rate, and we talked about how the 10-year Treasury yield is the benchmark for mortgages. Keep that in mind. Mortgages are not directly controlled by the Fed rates. They mostly manipulate short-term interest rates. When they go into the market and buy or sell 10-year treasuries, they can move those rates and it can affect mortgages quickly. But things like a crisis in Asia or Europe can also lead people to buy treasuries, and that drives the rate down. So we're seeing a short-term dip in treasury yields, and that's, I'm sure, affecting the mortgage rate market today. But longer term, I think we're going to see rates start to go up. So I never purport to have a crystal ball. I don't know exactly which of these forces are going to win out on housing, but these are the things we have to look out for. Employment, we're doing great. I'm going to try to be really precise with this. We're at 4% at last check-in in February, and February 2020, we were at 3.5% unemployment. So we're almost back to pre-pandemic levels. And I know there are all kinds of issues with how they measure unemployment, but let's just look at that benchmark and sigh a sigh of relief that employment in the U.S. is strong. That can be affected by local changes. If you work remotely or if you're in the service business, it might be more of a national influence on that. But employment is strong. Most of these factors, if I had to guess, are going to continue to push housing upward. And then the real question is, what happens with inventory this spring? Do we finally have more sellers that come on the market? All right, so this has the potential to be a really long one. I'm going to cut it off here. Take a look out for those factors. Send us a DM if you're watching this on social media. If you're getting this by email, write back, text me. We love to hear from you. And we love to have new topics to talk about although there's no shortage in changing factors in the world that we live in. Everybody stay safe and be well, and we'll see you next month.